is The Great Rotation, Life After the Magnificent Seven. And for those of you who don't know me, back in 2000, I had a hedge fund in the tech space that had done very well. And I actually was up about 50% in 5 months, got out in March 22nd of 2000, the day before the peak, and was out for a while, but ultimately gave back all my gains. And there was a lot to learn in that experience. And what that was is really after a major bubble in a particular space, such as a tech space, to look elsewhere. And had I gone into China, emerging markets, small cap value commodities, and like gold, it would have done really well. Um, from a macro standpoint, I think one of the best models to look at the S&P 500 is the risk premium model, which compares the earnings yield, which is the inverse of the PE. It's how much do you pay for the earnings of the S&P. And so, for example, if a PE is 20, then the inverse would be 5. And so how does a 5 earnings yield compare to a 4% 10-year treasury or a 3%? And the higher the yield on the treasury, the lower the premium. And right now, we've had a nice move in earnings, and actually bonds are ticking off. What's interesting is that we're hearing a lot of talk about it, a soft landing, a slowdown, and the risk premium has moved up. But it's moved up because interest rates have declined, not because earnings continue to strengthen. And at the end of the day, it's the earnings that we want to be tracking. So I think that we're at a very slippery slope. And just to be a little more quantitative and show how the risk premiums calculated, back in July, it was only at 0.17, and it's risen up to 1.17. And back in July, the yield on the 10-year treasury had a 4 handle. It's dropped to 3. And just it's worked very well. I got out at the top. I wasn't using this model at that time, but I did get back in 2009. And 2012, 13, there was another sell-off where stocks became very cheap. That was during the European crisis, and also in 2020. And so the point here is now stocks are expensive, but they've gotten cheaper, at least according to this model. But it's not because earnings have gone up. It's because interest rates have gone down. And I think that the risk here is that interest rates have rallied, bonds have rallied, interest rates have come down, but it's because the economy is slowing. So concerns about inflation have gone away. But who's to say that we're not seeing a slowdown and the positive signals to the bond market are maybe a precursor to a recession that could be hard? Recessions lead to 30% declines in markets historically. The risk premium has moved up here, but I think that it could be a head fake because bonds have rallied, or interest rates have rallied, interest rates have come down, the risk premiums moved up, but I think that earnings are actually flat. So we're looking at 241. They've been flat. And if this soft landing turns into a hard landing, hard landings, recessions can lead to a 30% decline in the S&P. I don't know what we're going to see, but watching this, I think, is very important. What you've seen is an improvement in the risk premium over the last 2 months from 0.17 to 1.13. That number, that's an improvement. It's not a screaming buy like it was when it was 6 in March of 2020 or 7, in 2009. But if earnings start to fall because the market, because we're going into a recession, that's a problem. I think the other issue, I'm a big fan of Robert Schiller and believing that psychology is a factor, and irrational exuberance is a wonderful description that encapsulates every bubble I've seen. And this June, when I saw that the Nvidia was the largest market cap company in the world, I said, this stock looks like a bubble. and I have written about it in letters and on Seeking Alpha, and we've seen a peak here. And I think that the problem that people have psychologically is recency bias. Keeps on going up, but that's exactly the experience that I had in 2000. Made a lot of money in tech. It has to be tech where future leadership is. It is not, and I think that's the idea here. I think what will bring Nvidia down is expectations are too high. The multiples are too high. You're now starting to see lower and lower uh, comparables each month. It was at 265, then 262, and then I think it was 135 last quarter, which is great. And it may go to 85%, which is great, but not for this multiple. And the history of this is that you're going to see this stock continue to come down, but it's not going to go straight down. I think it'll be a great trading opportunity. And actually, Rich Gula, I see, has a couple slides in his presentation, and we'll get to that. So by my assessment is you had a blow off peak and it sold off. There's a friend of mine is a former trader at CRT. He said, "Oh, I hope you made a lot of money." And actually, I didn't. I wrote about it. I said, Nvidia is a short and it broke down, but then it had a bounce. And I played some of the NVD and I actually traded that successfully when it went back up to 125. Yesterday, it had a big move. I haven't looked at it today. I would expect it to probably go back up to 125. So basically, you got a 140, 135, and then a 130 peak. And so I think about 125 around here I would look to be shorting it again. Um, I think that nothing against the company, Jensen Huang, and what the opportunity is from artificial intelligence, but when everybody has to be in it, that's usually a bubble and it takes a long time. I mean, just to put it in perspective, an 11-fold move in a stock in 22 months, and it was concurrent with the launch of ChatGPT. That's like that's a mania. And I think that the general factor, the rotation, was captured by a very talented technician, Ari Wald. And you'll see it in these equal weighted indices are now starting to outperform. And I think the cap weighted indices are at risk. So are we going to go to new highs on the NASDAQ 100 and the triple Qs? Um, I don't know. My bet is the way Nvidia goes is the way the Mag 7 will go, is the way the Nasdaq 100 or triple Qs will go, and then the S&P. Could be wrong, but I think that there's going to be a point here where I want to be watching these things, and if earnings start to break down or the Mag 7 and Nvidia, peak and start to roll over, I want to be short. And I think that I wouldn't go crazy, but that's my attitude. Another area where I think that there's great value will be in gold and gold stocks. As I mentioned, from 2000 to 2011, gold did incredibly well, and during that period, after the tech bubble, there was a great deal of money to be in gold, and I think that you have a similar situation. It's an asset that people are familiar with, and um, people are comfortable adding it to their portfolios. And I think that this is I think stocks are overvalued, bonds are overvalued, and real estate is overvalued because basically we went through a bubble in interest rates. Interest rates have moved up, and now basically all those asset classes are overvalued. So gold is a place where I think you can invest with relative impunity to the interest rate environment. One area, and I'm going to have Tony speak for a second on this because we were talking about some ideas that looked compelling, and he was talking about China, and we have an expert on China, Cheng Kui, who will speak after Tony. And Cheng was a guy in that I met in 2003. And I was running a hedge fund and I was looking around on First Call, and everybody, all these major Wall Street firms were putting out sell recommendations on all these Chinese stocks. And Chang was the only guy with a strong buy recommendations on Sohu, Sina, NetEase, and all of those stocks went up 100x. Now, unfortunately, I was probably still looking at Nokia and Cisco and EMC and Microsoft, but really, I'm wondering whether we may have an opportunity in China because some of these stocks look terribly inexpensive. And I'm going to ask Tony, could you just give us some of your thoughts and some of the names in particular you like? Uh,
Well, look,
you think,
yeah, sure. Look, I'm a contrarian, and especially now, um, I don't. I think it's correct that the Chinese economy has a lot of problems, but just as I think our economy is not nearly as good as the market thinks. I think the Chinese economy is not nearly as bad as the market makes out. And um, one of the things that struck me was that there was a lot of breastfeeding when the most recent Chinese services PMI came out. And it came out at 51, I think 51.6, when 52.1 was expected. And you got at least two or three commentators pointing out that this showed what a disaster the Chinese economy was. And that really is not true because 51.5 is still an improvement. The improvement wasn't quite as much as people have been expecting or hoping for, but it's still an improvement and not a disaster. Now, my my feeling is that China at this point is a great place to look for bargains, and I'm not saying I'm ready to buy the market out there outright, but I see two stocks which really intrigue me. The first one is BYD, and I think that in the last few months, BYD has come out with two new vehicles, which suggests that the company has a major technological and cost advantage over everybody else. And the first one is that they're producing an electric vehicle called the Seagull, which retails for about $9,700 in China. Now, okay, China is subsidized, blah, 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 and it's not ready for the foreign markets, but even if you double the price, which I think is excessive, it's still under $20,000 for a car with a 180-mile range, and according to reviews, has pretty good quality. The only negative that I've read about the Seagull is it's not fun to drive. But I mean, look, it's sub $10,000. If it's not the Yugo, it's a bargain. So the second car that they came out with is more recently is a hybrid, which apparently gets 1,300 miles on a tank of gas. Now, this is amazing because that's superior fuel efficiency, which also means superior operating costs. And I suspect that much as people don't like China, if they can save 70% on their gas bill, they're not going to be terribly unhappy about it. So, I mean, again, BYD stock hasn't gone up on these announcements. The earnings were pretty good. And I think long term, at this point, they have a technological cost advantage over everybody else. So I think the stock is a great long-term buy. The other one that I like is Dayquo Green Energy, which makes polysilicon for solar panels. Now, this is a ridiculously cyclical industry. It's like DRAMs were 10 years ago. And 2 years ago, this company was earning, I think, $4 a share per quarter. They lost that much in the last quarter, but the stock has gone down from a high, in the recent high of about 120 to 15. And it has almost a billion dollars in cash and no debt. And it's the lowest cost producer of high quality silicon in the business. And I mean, I don't think solar is dead. It's having its issues right now, but typically solar has been a cyclical business where you buy when it's having its problems and you sell when everybody else loves it. And right now you're at the bottom of the cycle or close to it. So anyway, having looked at these two things, I'm really wondering what else there might be in China that's interesting, because the market is not liked and there's opportunity there.
That's great, Tony. I'm going to have Cheng Kui. Cheng, if you could get on, talk a little about your background, substantiate the fact that you gave me 4 stocks that went up about 100x in the China space. It may not be obvious to some looking at you or your name, but you're Chinese, you speak Chinese, I believe you've studied at Columbia, you have like 1 or 2 master's degrees, and you were posting and doing equity analysis. So Tony threw out a couple names and thoughts, and I'd be interested in your general comments on the Chinese market and some of the names he mentioned, or any that you are intrigued by.
Okay, thanks, Tyson, and hi everyone. My name is Chang Qiu, last name Qiu. I was born and grew up in China. I came here in 1988, so time basically flies. I spent more years in US than in China. I got a PhD in applied physics in US, and then I received an MBA with Columbia University, and then I worked at IBM in New York. I got to know Tyson. That's like 2003-ish. At the time, after the internet bubble burst, basically many of the China internet names was trading under cash value. They are showing growth. They are still not profitable, but a simple projection, you can see them will be profitable. Very Lattice, Sina, and Sohu. Those are the internet names at the time. They are trading basically below cash value, and its revenue is growing. So that's where I started writing and publish with Thompson and Thompson First School, those place. That's when Tyson said he noticed me. But anyway, after that, I spent a few years in equity research. I was named by Wall Street Journal as the star analyst for the year 2005, 2006, published in the following years. And I joined a hedge fund in 2007. I worked in that hedge fund between 2007 and 2018. That's like 11 years. We did a secondary market, and we also did primary market, which means we entered into the venture capital, the private equity space as well. I left Sansar Capital in 2018, and in the last few years, I provided some consulting service, and also I'm the CEO of a biotech company called Trim Medicine right now.
What I'd like you to do, Chang,
back
is
to Tony's earlier discussion. I agree with his point. Right now, China, the space is not liked. A lot of names basically was trading under very, very deep value, trading under a few times of earning multiples. You know, DQ is a name is cyclical, is losing money right now, but there are a lot of names in the space. You know, they are making money, and they are, you know, the PE ratio is like under 10 times. For example, I can add two names to the list. One is Weibo, the ticker is WB. That's like a Twitter in US. They have you know, 500 million-ish users, and even in the suppressive environment in China, they have the basically a quite active community. They are trading right now, I think, you know, under $8. That's like 4 times PE ratio, and they have like $2 billion of cash in the balance sheet. Another name you guys you can take a look is a PDD. That's a e-commerce player. The stock was down like the other day, like down over 30-some% in one single day because they are guiding down their growth. In the past, they are growing something like 80, 100% year over year. Now I think they basically in the call they mentioned they are facing competitions, and also US like Amazon, they are going to the lower they kind of also want to you know, use merchants in China and more try to compete more directly with the Pinduoduos of the world. But anyway, even with that guide down, I think they can grow from now 20-some% per year. That's no problem. And the stock was trading like 8 times kind of earning right now. So I would think that's also a great value in this space.
That's great, Chang. Thank you for your thoughts. Tony, you have any quick questions for Chang, or should we go on to Rich Gula?
Well, I just think as far as DQ is concerned, the fact that they're actually losing money right now is great, because what happens is that they're a low-cost, high-quality player, and when they lose money, their competitors lose a lot more money, and they either very quickly go bankrupt or just go out of business. And when that happens, the price of silicon, polysilicon rapidly turns around. But I appreciate Chang Key's names. I've been watching PDD and wondering whether that was a buy also. So I really appreciate his opinion. I'll probably buy some. So I mean, again, as background, I mean, I bought a lot of stocks in Argentina 6 months ago, and was pretty much laughed out of town. I still like Argentina, although I'm not in it right now because it's become too fashionable. And I think if the US market corrects, you'll get a correction in Argentina also. But since China is pretty much hated and despised, the likelihood of the U.S., a correction in the U.S. being translated into a correction in China is much lower. So,
yeah, another point to add here. I think Tony had a lot of good point here too. I think another thing we should pay attention is the U.S.-China relations. I think that's one of the major hurdle that's preventing a lot of investors into investing in China space. I would think if anything lessen up, for example, recently they have U.S. military leaders meeting with China military leaders. I think that's a kind of like a good progress. Anything on the warming side, not get to the more enemy side, that would be helpful for the space.
Well, I would like to throw another crazy thought out, and that I think that if Trump wins, this is bullish for Chinese stocks for two reasons. One is that we don't really know what Trump is going to do. The tariffs might be, a trading ploy, but even without that, with Trump's contentious relationships with our other would-be allies, they're going to feel a lot more positive towards China if they have to deal with Trump's feistiness. So I think Trump would be more of a positive than a negative for the Chinese stock market.
I tend to agree. What I'd like to do now is actually move over and have Rich Gula speak, and I have some slides, and we'll move on, and then we'll come back and have a little more Q&A. But Rich, as everyone knows, consults to about a half dozen fund managers over at Fidelity up in Massachusetts, and he's been around and sees where the big money goes and is most astute. And through that, Rich Gula, institutional market analyst. Rich, are you there?
Yes, I am. Can you hear me?
Okay. So Rich, as you know, consults. He's worked for Dean LeBaron, a great quantitative analyst, and he also was the special projects manager under Ned Johnson at Fidelity, and still advises probably several hundred million, 300 million in assets up at Fidelity and knows all the players there, and he's seen it all. So, Rich, what do you got here? It says REITs.
Yeah, I'll give you a quick overview of what I think's happening, and then we can go through the slides. I think the biggest theme that's going to play for the next several weeks, and it'll be played out in the market in the sense of rates versus REITs. Iron Mountain is a very hybrid kind of REIT, and you can see from its performance, it doesn't look anything like the mortgage and a number of the CRE linked ETFs that are out there right now. But what's interesting is that REIT funds own things like AMT, American Tower, which isn't quite what I would think of as a REIT, but it's classified as that. Secondly, the rate cut is fully debated in the market. It's in the market to a certain degree. Financial stocks are going to have to respond positively to whatever happens then to bring this market to higher levels. The rotation is getting a little stuck. The small mid-cap averages are I would call them, they're sort of zoned right now. They're kind of sideways. That doesn't mean they're negative. It just means that it's stock picking that is going to come to the fore. I worked with a small cap manager for many years outside of Fidelity. Two things he told me. One is that I know every company inside out. And secondly, I can always find 200 stocks out of the 2,000 that I like. So when there's a generic discussion of small caps that goes to the Russell, it really is a false narrative, in my opinion. In the mid cap area, there are ETFs that do the value versus the growth of the EMD, which is the future symbol. MDY is the State Street offering that gives you instant exposure. Value is much better than growth. Third, there's an exhaustion in tech, but that's in the popular tech, I would call it. In the fundamental side, if you do a relative strength of Oracle to Intel, that tells you what is going on inside of real tech, as I would call it. Materials, which is a rotation theme. You'll see a material slide, and Linde is the largest holding, which is interesting, not a paper stock, and it's a sort of specialty chemical. There's a CRE theme of commercial real estate that hangs over the market. It shows up in a couple of charts. Schwab has a very nice REIT, and lo and behold, AMT is the largest holding by far. I just mentioned financials have to rally, and there's been a retail recession for a year and a half. It's in Nike, and whether it gets to Dick's or not, we'll soon see. And then we'll make a comment on Nvidia at the end. Okay, we'll do the stocks charts pretty quickly. First, Iron Mountain. If this is a theme stock that has to hold
Are they
together.
Data centers?
It's the old Iron Mountain used to be what you hired to put all of your records into storage, and it morphed into a save your hard drive company. I knew the founder and the owner, a guy named Vinnie Ryan, quite well way back, and what it turned into was that it owned all of its warehouses. So now it's a REIT, interestingly. Next slide. Small caps. That's the small cap future, but it's the same as the IWM. Notice that's it's stuck in a zone right here. Nothing bad. And it's green circle down the bottom. If you're being price sensitive, if you could get that little yellow line in the bottom corner to go down and then turn up, we'll find out how much interest there really is in the broad area. But there's plenty of opportunity there. Next slide is the materials, which I mentioned before. That's actually more positive than I think most of the commentators are making it into be. And so that rotation's still there. So you're out of Nvidia and you're out of a lot of I hate to say it, a lot of the AI stocks, and you're into something kind of boring for a little while, at least. these are the holdings. Notice that the way a lot of these ETFs, and I wanted to bring this up because it's something that everybody's got to deal with. Most of us flunk a quiz in terms of believing that most ETFs are just market cap driven. State Street certainly would give you that impression in their literature. I don't think Lindy is 21% and Sherwin-Williams is 8% on a market cap basis. I could be wrong on that. But notice the names there. Nothing. Most of these names are, other than Freeport, which is obviously hardcore, and Newmont. This is and Nucor. This is a tricky list. I'll be calling this materials. Next slide. I think that if I were going to talk to a manager who is trying to make sense of the market, I'd say get onto the equal weighted S&P and have your staff analyzing that all the time. And that's got to be the list that you've got to work with, not the cap weighted. That's tricky in terms of firms that want you to mirror or embrace the index. About 2 years ago, I heard from various sources at various firms, without mentioning any, that the active managers in their 50s are being told that it couldn't go more than 1% outside the S&P weights, and their bonus was on pure alpha. But they beat the sector by stock picking while staying neutral within it. Good luck with that. Mid cap, it's got the same pattern as the small caps. Next slide. That's using the future. These things are trading in parallel. The correlation inside of a very, very simple price model is very, very high right now. They're moving together all the time. The next slide is, hold on.
Mortgage.
Mortgage. Yeah. And that's where the problem is out in the system. This is a pretty large mortgage ETF that's been on the edge of breaking up for quite a while now. There's still a chance of contagion in the markets that it's still being sorted out. I also notice the circle on the volume in the middle there that occurred back in, I can't see in terms of my resolution here. When was that?
I don't know, July?
Yeah, in July. There was a crisis out there that somebody addressed. Somebody got out and somebody knew it was coming. And the crisis really got turned last October. So there's still lots of worry at the Fed meetings in terms of where the real issues are out there. You can skip. The next is just another view of the holdings in the XLB. Notice Boston Properties, which was having a lot of trouble too, has gotten saved. That seems to be out of trouble. And you've got to at least mention Bitcoin, since the whole demographic slice of the trading community is being killed right now by this, since most people didn't get that decline. Schwab, by the way, runs a treasury ETF. And I point this out only because if somebody wants if you want to do an entertaining hour, go to something called the Boggleheads. It's a group that is basically disciples of Bogle. I call them Boggle, but they're Bogleheads. And they have a book out and a nice CD called the 3-Stock Portfolio from 20 years ago. You could expand that out to 15 to 20 ETFs. And if you were running $2 or $3 million of your own, this would be a core stock every time you wanted someplace to go for cash, so to speak. The REITs, the Schwab REIT fund, which I'm now showing in the next slide, looks like all the others. But what's interesting about it is that, lo and behold, it doesn't own a lot of the problematic ETFs. They've done a good job, but those are all cash cow. Public storage, extra space. Simon Property is one of the better property ETFs that's out there. And obviously American Tower is the one that everybody hides behind. The top 10 holdings in that Schwab fund are 50% of the entire fund. And you can skip the next slide because it's just another view of the Schwab ETF. The slide of the XLF is probably the most important one in the whole marketplace right now. JP Morgan had there was a wisp of an error or a problem there. Not an error, and the stock was off 4 points or quite a bit, 4% in one day. This is the powerhouse that it's got to keep going, and I would also urge you to go to the Bank for International Settlements database, both database and their website. There are capital requirements globally that are supposed to be coming in, that the BIS is the sort of keeper of the credit world that nobody really talks about in the U.S. And there's going to be some contention in terms of whether they're going to accept the capital ratio stuff that they're trying to impose. Next slide is Nike versus Dick's in the XLY. I still think that there's been a recession that's segmented, that's been out there for a long time, but it's not showing up in the aggregate data. And let's see now. Last couple slides, Nvidia was probably a top on that whisker where I drew the line. You don't call tops in stocks that have gone up this strongly for this long, but I'd be very. You got to start trading it as Tyson has. What's interesting are you can get a better view of Nvidia in the next slide, which is more of a blow up. Keep in mind it split 10 for 1, and 10 for 1 splits tend to be dilutive in my experience. It takes a while before everybody gets used to the new pricing and the access of new investors. But the next slide is who's pricing Nvidia. The Mag 7 ETF is probably doing as much as anything. That the correlation with Nvidia is high. And inside of Nvidia, the last two slides are a 2x up and a 2x down. These are derivative ETFs. They probably are using futures and options, and they double the move in Nvidia every day. And they're trading quite heavily along with the last two elements, the SOXS and the SOXL. Trade about 200 million shares a day, and they triple the move in the semiconductors. So there's now a derivative equity complex. Why it's important is you don't get margin calls in these that you could in the future on a bad print. And they're very active in terms of deciding the 3 and 4 day moves that exaggerate any news item. So long and short, I think that you trade sideways and more up than down, but there's a 20% down from any extreme high that can happen at any time. But I doubt that it would stick. All right, thanks, Tyson, and wish everybody a good fall, and I hope your Nvidia trades all are good for you.
So let's see here. Walter Harrison, you're on mute. Do you care to chime in? Do you have any thoughts? You're muted, so maybe unmute. There you go. Walter, what are you thinking these days?
Well, I think everything's all right, but I don't have anything too earth-shattering. As you guys know, I've never been in the Mag 7s, and
I don't know what just happened. I can't hear him.
I believe in real energy and gold, and been that way for a couple of years, and it seems to be working out. I would love, Chang, if you could give me the symbols of the stocks you mentioned earlier that you're looking at now.
Chang?
Yeah, you mean I gave out the two tickers. One is a WB. That's like a Twitter in China called Weibao.
I'm sorry.
What is that? Walter Bryan? What is
Walter Bryan, yeah.
Okay. WB, YBOW. Okay.
Yeah, the basically the P ratio is about like 4 times. It's
Yeah.
not growing much. Basically, the core of their revenue is advertising revenue. That's you can understand in the current China economy, you can hardly grow the advertising revenue because of the domestic economy weakness. But in terms of other metrics, like how active the users, uh, the total user base, the time people logged in, those kind of metrics is still very healthy, growing not very fast, just like a steady and slow growth.
What's the other one? What's the other name?
The other one is PDD, Pinduoduo. That's an e-commerce player. That's like a high growth. P like a Peter, D like a dog and a dog.
And what do they do?
It's e-commerce. In China, they compete with the like Alibaba, like Jingdong, and in the US, they are, in a sense, is competing with Amazon. In US, or outside of China, they operate as Temu, Temu. That's their brand operating outside of China. P like a Peter, D like a dog, D like a dog.
And that's it. And
Right.
is that traded here?
It's traded in US. Is the market cap is actually still quite high because their earning it's a huge company, but the P ratio is like right now, if you use the forward, it's like under 8 times. I'm using something like 20% growth because in the past, this company was growing like 80, 100% growth kind of year over year.
Very good.
They are guiding down in the most recent quarterly earnings report because they are saying they want their growth to be more sustainable. They think the competition environment is heated up, and they want their merchant supplier base to be healthy. Want a satisfied customer base. So they are guiding down for their future growth. But in the past, the growth is very high, like over 100% per year for many years.
Got it. Now, getting back to the first one, WB, what was the next letter?
That was it, just WB.
Just
Just
WB.
WB.
Yeah.
Okay.
Yeah.
Oh, very good. Well, thank you.
Okay.
So I got somebody else that wants to speak. Robert Levin is on the Zoom call. Robert is a adjunct professor. He used to actually, he was at one point. Let me continue. He also did some macro consulting for Louis Bacon and Paul Tudor Jones, and he is about as knowledgeable a person as I know. He knows more than I. He's forgotten more than I know. He made some comments with regard to Nvidia, why there's a massive growth. But I won't argue the technicals. He created a translation company and done some other things. But he has a great deal of he's very well connected and has thoughts. So, Robert, tell us, what are your thoughts? What jumps out at you?
So on NVIDIA, first of all, excellent presentations by you and everyone else, Tyson. It's brilliant who you brought together. Thank you. And I took detailed notes. I hope that we can do more marketing of your webinar because it really is tremendous value. And I told 4 people about it, but only on short notice. Anyway, so NVIDIA obviously is, $3 trillion market cap. And because it's a leader in AI hardware and the GPUs are crucial in model training, obviously the catalyst of ChatGPT started the rally last year, but now it's continuing because of autonomous vehicles, medical imaging, and industrial applications of AI. And this will accelerate in the first quarter of next year with Blackwell. which is a new chip being manufactured this year in Taiwan for NVIDIA's clients. So this will supply new chips to data centers next year, and I don't think that's fully discounted in the market. Yes, there are forecasts for revenue next year based on the Blackwell chip, but I would encourage everyone who is trading NVIDIA to monitor Blackwell and the adoption rate, on the quarterly reports, and attend quarterly conference calls because there's a lot to learn there. Secondly, gold, I think the biggest drivers are central bank purchasing by Russia, China, India, and Turkey, and other emerging market leaders who are developing some hedge against inflation, mainly that they have much higher inflation rates than we do, and they're lagging in terms of the decline of inflation. And so I would monitor closely monthly central bank purchases to see what the catalysts are in the next leg up in gold. And so those are my two thoughts for the day, but excellent presentations. Really learned a lot. Thank you.
Okay, well, I've got everybody pretty much on mute. But does anybody have any? We have two new guys, Neil Winnard and Philip Koch. If either of you have any questions.
While they're waiting, I'll make another final point on NVIDIA. There's 14,000 startups in their startup program. They have over 100 OEMs marketing chips to various industries, and they have tremendous. I mean, mainly they're going in the direction of software layered on top of their hardware. So they're offering APIs to startups to have basically access the chips online that in data centers, so they don't have to buy the chips, which are 60 to 70,000 each. They can rent them through subscriptions. So the model has made it easier for small and medium-sized business to license the NVIDIA horsepower. And the GPUs are going to accelerate and grow in power next year, and I don't think that's yet in the market. Anyway, so
thank you, Robert.
We can talk about NVIDIA. Thanks. Bye-bye.
So Neil, any questions?
Yeah, I do. Thank you for inviting me to this. Tyson and I met, and we sort of both were on a panel at a family office conference this week, and I think Philip was also at the same conference. And there was an interesting presentation given at the end by a fellow called Daryl Montgomery, and he had some things to say about China. I have a question for Chang about China, which is essentially, I think most of the market right now is treating the prospect in the next couple of years of China doing something with Taiwan as a low probability, high impact event. And I would be curious to know what your view on that is, because obviously if that's a high probability, high impact event, that's a huge sort of thing for Nvidia, because we're not going to complete the reshoring of chip manufacturing in the next couple of years. So I'd love to hear what your thoughts on that are,
Chang?
Yeah, I think that's I mentioned earlier. In this week, there is a phone call between U.S. Asia Pacific chief, military chief, with the corresponding China's counterpart. The military communication was disrupted in the last few years, and then President Biden, especially I think a week ago, is the U.S. Chief security officer visited China, and they re-established the communication, the military communication. In a sense, I think that's a good progress for the U.S.-China relations. At least that can hopefully prevent any heat hot wars or anything.
Mm-hmm. No, I mean,
I
obviously, it's
agree. I
really.
agree. It's a big problem if they really, invade Taiwan. That everything, every bit would be off. Nowadays, the wars nowadays, you send the unmanned, vehicles, that can bombard the TSM factories just in a few minutes.
Right.
You,
No,
you,
that's good. That's good to hear your thoughts on that, because I think it's been pretty clear that, for example, the CEO of Raytheon has already said, look, there's no way they can disconnect their manufacturing dependence from China
right.
in the short to medium term, because they are so dependent for that. So it would appear to be a foolish thing to allow a deterioration in relations to continue. And it is encouraging to see that the administration is establishing those communications. So I'm glad to hear you say that. Thank you.
Yeah, the week earlier is Mr. Sullivan. Basically, he met with China's vice chairman of the whole military. That's basically the person next to Xi Jinping. And also, there are rumors that in the military, China military, he is the real person in charge, because Mr. Xi Jinping, he is just like, in US, President Biden is the commander for the military, but actually the military, you have a military, commanders there too. So that's what Mr. Sullivan met the week earlier. He was the real military, basically next to President Xi Jinping, and he is the real military leader there. So I would think with this kind of communication and dialogue re-established again, I think that's a positive development for the U.S. and China relations.
Thank you. I think that's great. Philip, do you have any questions?
Hey, Tyson.
Or comments?
Thanks for including me on this, and it's been very interesting. I don't have any questions, but it's been very informative, and I like the team you've got here. You've got some smart people here.
Thank you. And anyone else?
Tyson, just one last comment.
Yes, please, Rich.
I did a quick Google search, which these days identifies you as somebody that is naive and unaware of what the world's all about. But according to the Google search, TipRanks, which is a database I encourage everybody to look at. I don't own it. I don't use it all the time, but I've looked at it quite a lot. It indicates 1,163 ETFs own Nvidia. But ETF.com, which is more of an industry standard, claims about 450. Either way, somewhere in between is probably the real number. When you're thinking about the price levels and valuation of the stock, think that you may be in the midst of a crowd deciding which way to go. And it may not have much to do with the valuation or if what the company is actually going to do in the next 6 months. Anyway.
Thank you. I think that, I can't argue against Robert Levin's understanding of what Nvidia does and their GPU growth rate prospects. But what I do know is that historically, human psychology repeats itself. You go between extreme panic and you have manias, and it feels like there could be a mania in AI. And I used to be a big follower of O'Neill, William O'Neill, developed IBD, one of the first quants, and he had a rule where if you had a certain degree of slowdown in the earnings growth rate, it was a sell signal. And it didn't matter really what the future growth is. So I have no doubt that there's going to be growth in AI and Nvidia. But the issue is you get momentum investors and you have so many of them. And I think it's actually particularly interesting, Rich, how you have highlighted these double inverse and double leverage vehicles to play. I mean, if there isn't, I mean, what could be a more volatile stock on the large cap in the large cap world than Nvidia? And you have a product which is trading millions or probably I don't know how much, but massive volumes, both as double shorts and double longs. And you know, in talking with Tony, who sometimes says, "God, I feel like this market can blow up. It feels like 1929," and I'm sensitive to that. And in 1929, there was massive margin. The risks, and Rich, you talk about this a lot, is some of these vehicles that have been developed have created so much leverage. I mean, I know in London, they have like a 5 times Magnificent Seven leverage portfolio that you can trade. And how many of these institutions and hedge funds are sitting there? And, you know, it just leads to wild swings. And when it turns ugly, it could get real ugly. And it'll be real interesting to see how it plays out. But thank you, everybody, for joining. And we'll talk soon.
Okay, thank you, Tyson.
Thank you,
Thank you,
Tyson.
Chang, Rich, Neil, Philip.